Dear investor, in the last edition, we had noted that India is well placed on parameters like external debt to GDP, short-term debt to GDP, and while our forex reserves have dipped, they are still at very comfortable levels. This has allowed the economy in the country to continue following the high growth trajectory, and our equity markets have formed naturally, responded naturally to the same. This is not the case with several countries, with most large countries seeing low growth, if not negative growth. India is standing out as probably one of the very few, if not the only, large, diversified, strongly growing market. And a market where this should prove to be sustainable. This is leading to premium valuations in India versus other regions, something that we believe should sustain into the future. Over the past 2 months, growth markets like India have responded well to a decline in bond yields in the US. Yields have declined in response to fears of economic slowdown on higher central bank rates in the Western world, and yes, lower energy availability in Europe itself. Lower commodity prices and lower yields have coincided with the change in the direction of FPI flows. FPIs, who were large net sellers in the country for many months, turned net buyers. Once again, India is a growth asset, and a lower bond yield increased the attractiveness of the same. With continued inflows from domestic investors, we keep saying this. The domestic positive flows should prove to be way more structural than volatility in FPI flows. Well, the market quickly retraced most of the fall and is now hovering closer to 18,000 levels. Q1 earnings season has ended. Low base effect helped several industries. On a positive side, now on a 3-year basis, most industries are delivering positive growth. Commodity price declines, price impact on inventory, margin compression, and economic slowdown fears have impacted the outlook. And after the result season, there is a small drop in consensus estimates for financial 23. And I would say some drop in financial 24 as well. We were relatively conservative in our estimates, and we see consensus now converging to where we were. Nifty EPS numbers are now thought to be in the range of 850 to 860 in 23 and 950 to 1025 in 24. A combination of small yield increase, strong market bounce from the bottom, and some EPS downgrades has resulted in earnings yield gap with bond yields widening on the unfavorable side. Pointing out to relative unattractiveness of equity markets versus bond markets. While on price to earnings, the levels do look sustainable, especially given the changes in the indices in favor of higher quality, higher valued names. The yield gap is unfavorable, and one should expect a period of consolidation. Of course, a drop in commodity prices, oil in particular, and hence yields should help market sustain and maybe improve current levels. So watching the direction of oil and yields is something that the market is going to do going forward. Going forward, index performance should track earnings performance now that the discount to value has been realized. In terms of key risks, I believe we should remain focused on the Forex level. This is a period when Indian economic growth would be sharply higher versus the rest of the world. Large regions of the developed world would probably see a degrowth on higher interest rate and tighter monetary policy and disruption in energy supplies. China is seeing a growth slowdown on COVID. Economies like Bangladesh, Sri Lanka, Pakistan, etc., are facing unsustainably low forex levels. The thing is that if we continue to grow faster, what we should expect to see is a wider trade deficit. As we would import more to fund our growth, and the world would need less of what we produce, so our export growth would be slower. Trade deficit is already crossing $30 billion a month mark, and the next 12 months on a run rate basis could see trade deficit, being in the region of $350 billion or maybe more, central was. Now, net services exports of 130 billion, remittances of 90 billion does reduce the pain. One can pencil in FDI, FPI inflows of around 30 to 40 billion. Yet, on account of, let's say, interest and dividend payouts on the assets foreigners hold in the country, and the other reasons spoken about before, one should expect Forex to drop by, let's say, ballpark $100 billion over the next 1 year on a run rate basis, almost like 2 billion a week. In this context, again, the price of oil is important. A dollar reduction in oil price is 1.3 to 1.4 billion saved for the country, and hence a price of below $70 to a barrel would save the country, USD 40 billion on an annualized basis, and would help maintain the levels of the forex much better. We again note that level of forex is important for allowing an economy to function normally. In cases like what we have in the present, our neighboring countries, for example, are unable to see growth in spite of sharp currency devaluations, just because they don't seem to have adequate forex reserves. Oil prices hence have been a large influencer on our stock market direction. When our markets have fallen, when oil has risen, and risen again when oil has fallen, and this cycle has been repeated twice already. We have a few tricks that we can fall back on. We have the ability to raise forex deposits from NRIs over and above global bond markets and multilateral loans. Our large diaspora does provide us with this strength. Inclusion of India in foreign bond indices, a move that was expected at the start of the year and may now happen probably next year, would also help bridge the gap. Reduction in forex has another effect. It reduces domestic liquidity automatically, and hence with the reduction in forex, domestic liquidity is now nearly normal versus surplus in the past. Lower liquidity is generally not good for asset prices. Oil itself remains a very tight commodity. The recent fall in oil prices is on account of global slowdown. Large parts of the globe are seeing degrowth actually. However, it is proving difficult to expand oil supplies significantly given the investment over the last few years as the focus on renewable increased. Already OPEC is pointing out that the current prices are below market realities. Oil prices could jump sharply, for example, if larger economies start to grow before new oil supplies are sighted and brought to the market. So this is something which needs to be tracked very closely. Also from this month, the pace of US balance sheet reduction would expand to 95 billion from 47 billion. And the impact of the same on bond yield and liquidity would need to be tracked. If the bond yields do not move significantly, this was something that we saw in the last 75 BIP increase case as well. Then I think the confidence of the market in the thought that the Fed actions, expected Fed actions are in the price would increase, and the equity market volatility would reduce going forward. We had noted in the last update as well that this period we should expect to see lower primary market activity given the volatility in the markets, and whatever money flow happens should all be directed to the secondary market. This should continue in September as well. However, we do expect to see larger sales by private equity in this period, as planned sales in quarter 1 could not take place. So there is some bunching up of sales from private equity that one expect or should expect to see in quarter 2. This to some extent should provide a lid to the market buoyancy. Quarter 2 result season is expected to be relatively subdued on account of higher base effect and inventory effect. The change in the direction of prices have been sudden, and businesses are left with higher cost inventory, which would hurt margin in quarter 2 before improving from quarter 3. So these are the risks that one should be looking at. Forex, oil prices, Fed balance sheet, the reduction pace increase, quarter 2 result season being the main top of the mind ones. To summarize, expect market to track sharp changes in bond yields and forex reserves, inflation, and oil prices. Quarter 1 result season was good overall. There has been some drop in EPS estimates for the market as a whole, but mainly driven by lower outlook of commodity businesses. Valuations, though sustainable, are now fuller, and investors should expect earnings growth related compounding going forward. Thank you and happy investing.